Howdy everybody, welcome back to another round of Accounting 1101. With you as always, I'm Professor Martin, coming to you from the home office here in Wilmington, Ohio. Beautiful, stormy Wilmington, Ohio today. A little bit of weather going on out there today. Hopefully everybody stays safe and get inside, watch a few accounting videos. We're going to be talking about inventory purchases in our video right now. How do we account for it when we go out and buy inventory to stick on a shelf to resell? And so let's get right into it. Before we go too far down the road, I want to make one point. Your book, and pretty much every accounting book that you open up will talk about two different types of inventory systems. They'll tell you about a perpetual and they'll tell you about a periodic inventory system. Now, the perpetual inventory system is probably what you're going to be most familiar with, and it's what you're going to see most of the time out there in the accounting world. It's an inventory system that keeps track of inventory all the time. And, it's using the barcode scanners, POS systems, and basically every time an item of inventory is purchased by the retail business or sold, it gets scanned in or out, and the system updates automatically. All right. Perpetual. It's always updating every time inventory is bought or sold. And so hypothetically, whatever the computer says is in inventory should be what's in inventory. All right. The other type of inventory system is called periodic. Usually it doesn't have a lot of fancy technology. It's used by mostly smaller businesses that don't have a lot of inventory or maybe don't have many different types of inventory. That system does not update automatically. It updates periodically whenever the accountants go out and count the inventory. Okay? The only time the periodic inventory system updates is when someone goes out and counts the inventory and makes accounting entries to update the inventory. Perpetual updates continuously as items are bought and sold. So we're going to focus on the perpetual. We're not going to spend a lot of time going through examples of the periodic system. They're in the appendix of your textbook, and some books they'll be kind of maybe at the back of the inventory chapter. But most of all the examples you're going to see are going to be perpetual, so that's what we are going to roll with. Our goals, as if you probably couldn't figure it out, is to learn how to do the accounting for buying inventory. We're going to talk about purchasing the inventory. We're going to talk about something called a purchase discount. And then finally, we're going to wrap up talking about purchase returns and allowances. And we're going to have journal entries to go with all of them. Our example business that we're going to be using throughout the discussion is Net Solutions. If it sounds familiar, it should, because that is the example that we used in our videos where we talked about a service business and we learned the accounting cycle. And that business did web page design and consulting for clients. The founder is still here, Chris Clark, making it happen. And business still began way back in 20Y3. But now, new and improved, they've expanded. And now instead of just providing consulting, they are now selling computer hardware and software. So we have inventory to keep track of. Got to keep the accountants busy. So our new account that we're going to be looking at, and we've already seen it if you looked at the video on comparing service and retail businesses. I already mentioned it. Merchandise inventory or just inventory. Asset account, it's going to be reported on the balance sheet under current assets. When we buy inventory, obviously the account's going to go up. We have more inventory. When we sell inventory, the account's going to go down. We have less inventory. Pretty simple, right? Just like every other asset account, it goes up on the debit side. It goes down on the credit side. As I mentioned before, everything you learned about accounting in Unit 1, it still applies. You don't have to learn a whole new set of rules here. We're just adding to it. We'll add new accounts. We'll add new concepts. All the rules apply. Okay? So let's talk about some journal entries. January 3rd, we're going to assume Net Solutions bought $2,510 of that good merchandise inventory from Bowen Corp. And they paid cash. And so we talked about how to analyze transactions. Your first step. What accounts are in play here? What is even going on? Well, we have two accounts. We have an inventory account we have a cash account. Step 2, are these accounts going up or down? Well, we're buying inventory, and so that's probably going to go up. We're paying cash. Cash is going to go down. So we know the accounts in play. We know whether they're going up or down. Our final step is to figure out how to apply debit and credit to it. Both asset accounts here, inventory asset goes up on the debit side. Cash goes down on the credit side. From there, we just make our entry. We debit inventory and we credit cash. We bought inventory from Bowen can be our description. 2510 increases inventory on the debit side. The cash account decreases on the credit side. Both on the asset side, so they wash each other out from an accounting equation standpoint, right? Assets equal liabilities plus equity. We know that every transaction is going to impact that accounting equation, and we know the accounting equation has to be in balance all the time. So we can pay cash for inventory, but that's normally not the way businesses do it. Normally, businesses buy inventory on account or on account payable. So January 4, Net Solutions buys $9,250 of merchandise inventory from Thomas Corp. Thomas Corp is extending credit. We are buying it on account. Buying it now, paying later. Inventory goes up, and now we have accounts payable, the liability, going up as well. We look at the accounting equation. You can see inventory on the asset side of the accounting equation is going to go up on the debit side, left-hand side. Over on the other side of the accounting equation, the right-hand side, accounts go up on the right-hand side. And so we now have a liability. We have a debt to Thomas Company to pay them $9,250. We can buy inventory, pay cash. We can buy inventory on account. Either way, we're debiting that inventory account, aren't we? Making inventory go up. So 2 good examples there for you. Now let's talk about the real world. In the real world, when we deal with all these accounting transactions, it's not like somebody comes into your office and whispers in your ear, hey, bought inventory, 9,000. Or anything like that. And people just don't come in and kind of tell you the transactions, nor do you have them in some big book that you flip through and record them, right? In the real world, we have to go off of a document. We get some kind of a source document that has the accounting information on it. This is no different. In the real world, we're not waiting for someone to come in and whisper to us, hey, bought inventory on account. We get what's called an invoice. An invoice or a bill shows what was ordered and the amount due. And we're going to use it to create our accounting entry. Now, that's in the real world. And in our fun little accounting hypothetical world that we live in and academia, the book will tell us. But in the real world, we get that information off a source document, like an invoice as you see here. So we got our invoice here, and we got the number, we got the date, we got the due date, we got what was bought, we got the balance due. There's also another little piece of information that I want to point out. You'll notice what I've got highlighted. It says terms, 2%, 10, net 30. Those are credit terms. They tell the buyer how many days they have to pay and if any discounts are available if they pay early. Oh, so we got to learn some accounting here. How do we deal with credit terms? First of all, we got to learn how to read them. 210 net 30. What in the world does that mean? It means you get a 2% discount if you pay within 10 days. 210. 2% discount if you pay within 10 days. Net 30 means you better have the whole thing paid within 30 days or you'll be late. And so that's kind of the ultimate due date. If you pay between day 11 and day 30, you don't get the discount, but you're still in good graces because you're not late with your payment. If you don't pay until beyond day 30, then you risk, somebody maybe coming out and hitting you in the knee with a crowbar because you haven't paid your bill and they're going to come collect. Hopefully nothing that graphic, but you're late, right? So 210 net 30. 2% discount if paid within 10 days. You have to pay within 30. Why in the world would someone give an early payment discount? Think about it. Why would a company do that? Why would a seller do that? Well, because we can't pay our bills with an IOU, can we? For the most part. We need money in our hand, right? And so if we extend credit, it's maybe in our interest to get people to pay as quickly as possible. The carrot on the end of that stick that we're dangling is if you pay super early, we'll give you a little price discount. Encourage you to pay early, okay? So, credit terms aren't always 210 net 30. They could be different things. They could be 115 net 30. They could be 5 net 30, all right? The first number is always the percent. Second number is the number of days to get the discount. The third number, how long you have to pay overall. As I said, doesn't always have to be 210 net 30. We could have 115 net 30, 310 net 30. We could have 15 net 45, or as you can see from our invoice right here, we could have no discount at all. No discount for you. You pay in 30. All right? It just depends on what the seller's trying to achieve and how quickly they're trying to motivate people to pay the amount that is owed. All right? So, the question from an accounting standpoint, now that you are familiar with credit terms, how in the world do we account for when a customer, not so much for a customer, when we take advantage of a discount as the buyer of merchandise? We bought merchandise, we got an invoice, we take advantage of that discount, we got a price break. How do we take advantage of it? Well, it's pretty simple. When we take a discount for an early payment, it's called a purchase discount. We simply reduce our inventory balance to reflect the discount that we took. We're adding amounts we paid to inventory as a debit to inventory. If we subtract amounts that we are getting as a discount, we subtract it out of inventory because we don't want that in inventory if we ended up not paying for it. So let's look at an example here. Net Solutions buys 3,000 of merchandise inventory from Alphatech, terms 210 net 30. If you see terms, the transaction is on account. All right, on accounts payable here. We don't need credit terms if they paid in cash. We only need credit terms if it's sold on account or bought on account. If it's in cash, we ain't got to worry about credit terms. So when you see credit terms, you're thinking if we're buying, account payable. You're thinking if we're selling, account receivable. Inventory goes up, accounts payable goes up, just like we saw before. Nothing special up to this point. But 10 days down the road, Net Solutions pays the amount owed less the discount. All right, we owed $3,000. We're not going to pay $3,000. We're going to pay the amount we owed, $3,000 minus a 2% discount. And so we're literally going to take $3,000, multiply it by 2% to get our discount. So let's take a look. Accounts payable is going to go away. The amount that we owed was $3,000. We're paying that off. We're only really paying $2,940. 100% of $3,000 minus the 2% discount. That 2% discount, $3,000 owed times 2% is $60. We're taking it out of inventory. Inventory needs to reflect all the amounts that we paid for inventory. If we end up getting a discount, we didn't pay that full amount, then we got to pull it out of inventory. And that's what we're doing here. You can see our entry balances, debits equal credits. The account payable owed goes away. Our inventory is adjusted. And the amount of cash we spent to settle up is credited to the cash account. So that's how we handle that purchase discount. Very simple. We run it back through inventory. One more thing to share with you. Sometimes a business is not happy with the inventory they buy. Just like sometimes you as a consumer are not happy with the inventory you buy. And when that happens, it could be damaged inventory, defective inventory, the wrong item was sent, whatever the case might be. The options for a business buying inventory are very similar to the options that you have. You can say, man, this stinks. I'm taking it back for a refund. That would be a purchase return. Maybe a little bit rare in consumer life, but not so much rare in business. You can get a purchase allowance. You say, well, this inventory stinks, but I'll keep it if you give me a price break. Not really what I ordered. There was some damage, there was some defects, but I'll keep it if you give me 10% off. So those are the two things that can happen. You need to know how to account for it. In both scenarios, we reduce inventory for the amount sent back or the amount of the price allowance. We don't need any special new accounts. We just run it right back through inventory exactly like we did our purchase discounts. For example, let's say Net Solutions returns 900 of merchandise inventory that it had bought on account. If they return it, they no longer owe the money for it. We debit accounts payable, and we credit inventory. That decreases accounts payable for the amount returned. It decreases inventory for the amount we no longer have because it was returned. Exact same idea if we got a purchase allowance. If they gave us a break on the price, we'd reduce the amount that we owed, reduce the amount of inventory. So you might think, well, okay, well, that's if we bought it on account. What happens if we paid cash? Well, guess what? We'd get our money back. Instead of accounts payable, we'd have a debit to cash. Easy as that. Pretty simple. Let's put it all together. Let's do 3 transactions. I'm going to have you work them out, and then we'll check your work as we like to do here. May 2nd, Net Solutions bought 5,000 of inventory on account from Delta Data, terms 210 net 30. Hopefully you know how to read that by now. May 4, returned 1,000 of the inventory that was bought on May 2nd. Then finally, May 12th, we paid for the purchase of May 2nd, less the return that we made and the discount. We always calculate the discount on the amount we owe at the time that we're paying. Right? So at that time, we only owe 4,000 because we sent back 1,000. We don't calculate on the original 5,000 because we don't owe 5,000. So here we go. May 2nd, take a moment, see if you can make it happen here. Net Solutions bought 5,000 of inventory on account from Delta, terms 210 net 30. I'll pause the video, let you knock that out. We'll come back and check your work. All right, hopefully you had a chance to work out that entry. We have a debit to inventory and a credit to accounts payable. May 4th, we return $1,000 of inventory that we bought on May 2nd. Again, pause our video. See if you can make up our journal entry for the return of inventory on May 4th. Hopefully you had a chance to do that. Let's take a look here. We have a debit to accounts payable and a credit to inventory. Lowering the accounts payable because we don't owe that anymore. Lowering the inventory because we sent that inventory back. Finally, the tricky one, May 12th. Net Solutions paid for the purchase of May 2nd, less returns and discounts. Remember, at this point in the game, we owe $4,000 on that accounts payable. We're calculating the discount on the amount that is owed. So take a moment, see if you can figure out the accounts in play, see if you can figure out the numbers involved. All right, here's the big one, the tricky one. Let's end on a high note and see if you got everything correct. We have a debit to accounts payable for the $4,000 that was owed. We have a professor who hits the wrong button and moves too fast on the slide. We have a credit to the cash account, $3,920, which represents the $4,000 owed minus the $80 discount. We get that discount by taking $4,000 times the 2% discount. Gives me $80. So of the $4,000, I paid $3,920 in cash, and I run $80 back through inventory to represent the discount taken. The big takeaway, gang, the inventory account reflects the total amount we have paid for the inventory we have on hand. If we have a purchase discount, if we have a return or an allowance, we reduce the amount of inventory to reflect that. Okay? We reduce that inventory account. That way our inventory account just reflects the amounts that we've paid for inventory, not the amounts that we've gotten back when we return, get a discount, or an allowance. So that is the game we're playing when we buy inventory. We have another big piece of the puzzle to cover. Obviously, we buy inventory. At some point, we'd love to sell it and make a little money. And so that's our next video. We're going to talk about the process for making the journal entries to sell inventory. big topic. I hope to see you back here for that. Until then, take care, everybody.